you realise you've got a problem because things haven't been done by the right time. The legislation doesn't actually say, well, then you should repay it. Even if you're late, you still should try and repay it, or you still should put the great loan agreement in place and charge interest. But the reality is, this comes probably from the ATO rulings, which I mentioned on the slide here, and the PSLA, that as a matter of practice, if you want to get discretion under the Section 109RB, you need to work out, well, what should have happened, and basically work out effectively catch-up interest. So for a couple of years late in making the repayments, because you've only realised a couple of years later that there's been this 7A issue, then you need to go back and work out, well, what interest would have accrued over the last couple of years at the relevant rates, work out what the repayments, basically bring everything up to date. Have the agreement, even though it might not have been made by the right date, still have the agreement, make all the repayments, and then you're basically putting yourself at the ATO's mercy, saying, we've done it late, but done everything we're supposed to do. Can you give us discretion to treat us as having complied? And so this is the sort of on the second on the right hand side of the slide there. It's converting the payment or debt forgiveness, can arise with debt forgiveness as well. So making the catch-up shortfall minimum repayments with the appropriate interest, having the loan agreement in place. And there's a lot more detail you find in TR 2010-8 and PSLA 2011-29. So that's where the ATO gives examples and has a lot of more discussion about these issues. Again, just continuing getting into more detail on that. So some of the circumstances that will support an honest mistake or inadvertent omission. And these are very subjective terms. So you really have to look at the circumstances and facts in each case. Fact the transactions were commercial, they're accurately and completely recorded. Touched on before that the entities involved have a good compliance record. And if they have had Division 7A issues, they've made genuine attempts to deal with them, but for some reason something may have just gone wrong this time. If they reasonably relied on professional advice, or adopted a position that is a common mistake or omission, then that will be taken into account, certainly. Also, if there's complexity, the complexity that the facts involves, if there's novel or contentious issues of law, whatever that might be, or if there's a lack of the ATO advice or guidance on covering the facts or the law. So these are very general points. I mean, the fact is there is a lot of guidance out there for most situations that we'll come across. So perhaps something that's, if you're dealing with something that is unusually complex or fairly unusual circumstances, then that would be certainly something you would put forward to support an application for why the ATO should show discretion, but they're certainly not required to. That slide's, I don't know how easy that is. People can probably read it on their computer. I certainly have trouble reading in the room here, so I generally don't like to put this many words on a slide. But this just is I guess just a few things taken from the ATO guidance that goes through. These are things that weigh against getting discretion, and you read these slide and apologise. Those in the room may have trouble reading this, but you are certainly on your computer screen you'll be able to. And when you get the slides, you get the flavour. It's all things like words like uncommercial, artificial, not accurate or complete, behaviour that does not support a conclusion of honest mistake or inadvertent omission. So if the ATO thinks someone's trying to get away with something, if the taxpayer or the tax agent had relevant knowledge of Division 7A, they should have been able to think you should have known this stuff and you didn't comply. Certainly if they've had previous Division 7A issues, that would be a problem. Or if they just have a poor tax compliance record, clearly that's not surprisingly, that's going to weigh against them. They also throw a few other points in here, like if the entities consciously unreasonably avoided getting advice, if they didn't get advice because they didn't want to get an answer they wouldn't be happy with, the ATO would say, well, you should have got advice, you should have got sought guidance. Or if they unreasonably relied on or ignored advice, they did get advice, but the advice perhaps wasn't reasonable, or they got good advice, but they chose to ignore it. All those things are going to go against them. Again, as alluded to a minute ago, if it's a fairly straightforward situation, or if there's transactions that are identified in publicly available or relevant ATO advice, if these are things that are covered in ATO rulings and guidance, pretty vanilla sort of transactions, much less likely to provide discretion. And I'll give an example here. So this is a couple of examples from TR 2010-8. The first one is fairly straightforward. They just made a mistake. They it's a simple miscalculation. So they had miscalculated the minimum repayment. They hadn't made mistakes like that before or since, it was just an error that was made. But they were aware of the requirements and tried to comply. And there's no evidence to suggest that it was anything more than an accidental oversight. So the ATO, I guess, tries to give that as a fairly simple example of where they may allow discretion, and probably will, if it really is as simple as that. On the other hand, and this is another example, it's a little bit more complex. So Jack and Jill are shareholders of their own private company, and they talk about checkbooks, which shows you how old this I guess example is. But you just substitute checkbooks with online banking. So Jill's not really involved in the business. She went and bought some household furniture, unwittingly paid it out of the wrong account, and for $10,000 for private furniture, and it doesn't sort of when the transaction's coded, didn't pick it up, and it goes unnoticed. So again, it wasn't actually intended. It was just that it came out of the wrong account and wasn't meant to come out of the company's account, business account. Then later on, when the tax return the accounts and tax return are being done, and that's when they discover the issue. Jack was looking through the ledger and sort of picked this up and said, "Oh, that's not right," and took correcting action, repaid the money in full, not quite by the required date, but certainly the ATO's view in that relatively simple and probably innocuous example is that that's capable of being treated as an honest mistake, and the ATO in this case can see that it was, so they're satisfied to give discretion. So there's bear in mind that this is from 2010, so probably the more recent comments by the ATO, where they would be less likely to grant discretion generally, might weigh against this. But they're, I suppose, a simple illustration of which is covered in the ruling about where discretion would be granted. But as we touched on in the previous slides there, with all the factors, there's a lot of factors that could go against them. So it's not an easy, it's certainly not an easy thing to get discretion from the ATO. So then we get to this section here of the presentation, which is about, okay, what's changed? And as I mentioned, what's changed is the ATO is seeing too much. They're seeing too many Division 7A issues, too many really basic issues that they think shouldn't be happening. Perhaps some deliberate, some not, but whatever the reasons, they feel that the Division 7A compliance should be improved, which is why they've gone a bit of an education campaign to try and raise awareness. And part of it is saying, well, we're not going to be as lenient. We're not just going to give discretion every time you ask for it. Even if, like we said before, you pick up a new client, so that it wasn't as the advisor, you didn't create this problem. You've identified it and actually advised the client to do something about it. You still may not get discretion because they should have got it right. Their advisor should have got it right at the time. And the way that in this webinar from last February, they talked about is this quote that that's like the company is there's been benefits taken, and the shareholder, it's like borrowing from a bank, and it's the cost of not getting it right is to apply Division 7A, because the community, I guess, in a sense, taxpayers, if one taxpayer gets a benefit, the rest of all the other taxpayers are essentially paying for it. So that's the way the ATO is looking at it, saying that people aren't doing the right thing. If they don't penalise them, then other people who are doing the right thing effectively lose out. So that's the ATO's mindset, I guess, and they're not cracking down too hard yet. They're trying to stop these things from happening in the first place and put people on notice, I guess, in a sense. So the key lesson here, what is the key lesson here, is that, when you take on a new client, you should definitely have a look, review their affairs generally, and specifically look for Div 7A issues. And you probably do. I'm sure a lot of you would pick up issues, but then it's, what do you do? the question, as we've been discussing, is what do we do about it? And and they emphasize, the ATO emphasises over and over again, you've got to identify these issues and then deal with them. So I'll move on now to okay, what do? You've got a historical problem, you say we deal with them. Well, what are your options? If you can't get, especially if you can't get discretion, what can you do? So there is also the idea that, well, as you'll be aware, the assessments have, and I've certainly looked at this in the context of having to advise on a situation that was being dealt with, and by probably someone in Henry's field, where there were receivers appointed, there was a whole messy group that was and it was a deceased estates, because one of the wife had passed away, and then I think subsequently the husband passed away as well, and there was all this stuff going on with lawyers and obviously receivers trying to identify what money was there and what assets could be sold and how can we get money to pay creditors, and in amongst all that there were Division 7A loans that were identified that had not been accounted for properly at the time. So this is one of the things to look at. Well, is there a Division 7A issue for some of these years, and are those years in fact out of time when the Division 7A loan would have arisen? So then you get the first point you get to is, well, if there's fraud and evasion, which should be pretty rare in cases like this, but as a general proposition, if there is fraud and evasion, the ATO has no time limit, so they can go back as long as they want. But really, that should be, and we're looking at Division 7A, that should be pretty rare. And if there's something like fraud, I mean, fraud is very serious, obviously, and even evasion is just a step down from fraud, but it's still pretty serious, obviously, and still has some significant consequences for taxpayers and advisors if advisors been involved in the actions. But really, if that's the case, you're probably unlikely to be, I think I might have this on another slide, but you're probably unlikely to be considered to be an honest mistake or an inadvertent omission if there's fraud and evasion. So again, probably unlikely in this area, but that's the first point to note, because then your assessment won't help. Then you move on to the question made with individuals. There's a 2-year amendment period for most individuals, as I'm sure most of you are aware. Limited cases where there could be a 4-year amendment period. So if the individual is carrying on a business and it's not a small business entity or medium business entity, likewise with being a partner in a partnership that doesn't fit into that small or medium business category, or beneficiary of a trust that is not a small business entity or medium business entity. And I think that's the one that we see a lot. And they can be a beneficiary of a trust. They don't actually have to receive the trust distribution. That's something that's often overlooked. So a lot of people are beneficiaries of trusts. So they might actually kick them into the 4-year amendment period, without perhaps even realising it. And that obviously has much broader application for a whole lot of things that might, if something gets identified. But in this context, it does mean you've got longer to worry about. So if a deemed dividend or potential deemed dividend arose within more than 2 years ago, perhaps you might be okay, unless you've got unless your client has a 4-year amendment period, and then you've got to be going back further. But if there's something that's 5-6 years or more old that suddenly comes to light, perhaps that assessment out of time. That's the point what we're making here. So you may not necessarily, there is a deemed dividend, but the client doesn't necessarily need to amend their, or can't. The ATO may not be able to, probably won't in that case, be able to amend their return. So there may be no actual practical consequences. But if they're within the amendment period, then it certainly is. So it's an issue you've got to deal with. The other one is forgiveness, and this question comes up a lot too. Can you forgive a loan? Section 109F applies to debt forgiveness. So you may not be a loan that's, or a payment or a loan that's subject to 7A could be a debt forgiveness. So you've got to bear in mind that Section 109F will apply in the year that the company forgives the loan. So as we were just talking about, you may have a loan that arose 6-7 years ago, and that assessment be out of time. If somehow that loan is forgiven through some action of the company or the directors, or there's a whatever is done, something is done that amounts to a forgiveness of that debt. That could be, they might shoot themselves in the foot there, because that would be enough to trigger a Div 7A issue at that point. So the Div 7A issue becomes not the original loan, but the forgiveness of the loan. So you want to find some other way to somehow repay the loan, or not necessarily with interest. So again, there may not be interest, or perhaps, again, I defer to Henry on an insolvent sort of scenario. But if somehow there's just not the assets to repay the loan, and so whatever process Henry or one of his colleagues goes through in relation to an insolvent entity, as long as whatever happens isn't, and the company might ultimately be wound up with insufficient funds to repay all the creditors, and as long as whatever is done does not amount to a forgiveness of that debt, assuming that's possible to do, then there shouldn't be a Division 7A loan. And maybe there's not a distributable surplus in that case either. Remembering that you have to have a deemed dividend, there needs to be a distributable surplus. So perhaps there isn't, but they're all things to look at. And that's something that, again, was commented on when we putting this presentation together, that Section 109G allow the taxpayer to avoid being taxed where the original loan arose in a year that was at a time for amendment. So it might not be a problem. Forgiving that loan may not be a problem, but you need to look at 109F and 109G together quite carefully if you're in that situation, to make sure you don't get tripped up. So again, assuming there is even a distributable surplus to worry about. So and I know there's been a bit of discussion recently. I saw some stuff this week about, or late last week, about 109U, and I haven't gone into this, but there's been a bit of discussion around it about where there's guarantees within groups, and that can become quite a complex with all these entities. And so and there's been certainly some feedback on how far that would go, and I'm not prepared to, I guess, to get it to discuss 109U. So I wouldn't be in a position to answer questions around that issue that's been discussed in the last week or so, but probably just refer to it, because I'm sure some of you may have read, there's something in Accountants Daily about that. Some of you may have read some comments about that. So it's and that certainly, my understanding is, it's when you've got guarantees and cross guarantees and various things that that are more than just a simple single entity situation. So okay, so a conclusion here is, and I'm coming to the end of the presentation here, so I think hopefully we're being reasonable for time, and if there are any questions, or more generally, happy to take any more general questions, but just to recap, it's strongly advised that your QC processes should be sufficiently robust. Your knowledge should be enough to identify Division 7A issues, know when there is an issue, and deal with it. Make sure that those of you that have staff working for you, make sure that they're fully educated, and you again identify Division 7A issues that you need to deal with. Pick up any new clients, again, to state the obvious. Look for, as we've been discussing, look for prior year potential Division 7A issues that may still need some action. They may not be out of time. There might be sleeping issues there that the time to deal with them is certainly when you first start looking at the client, not 2 or 3 years down the track and say, oh, actually, the issue, we've just realised there's a problem, and it was that we didn't do it. It was your previous accountant, but you're only telling them 2 or 3 years after they've been your client. That's not a situation you want to be in either. You want to the best opportunity is to pick it up when it clearly wasn't your fault. You didn't do it, but you're able to partly show your value, I guess, your knowledge that they've done the right thing by moving their business to you, because you're showing them that they've got things that they haven't been dealt with properly, and you're going to help them fix it up and make sure that doesn't happen again, so they don't get into that sort of risk. So that's where I get to here. And again, if you want to go into more detail on any of that, again, have a look at the ATO webinars. There's a fair bit on that. Look at some of those rulings and the PSLA on circumstances, and they go through a few more examples on. If you're looking at, there was a relatively recent private ruling given a few months ago, I think June last year, where somebody did get a private ruling on 109RB, but again, I think they're becoming rarer, and so that was the thrust of the ATO guidance anyway, that we're going to be a bit tougher on these things. So really try not to get in that situation in the first place. So that's the end of where I got to. So any other questions there, or from those in the room or online?
Yes, for private company.
Due to cash,
so we'll just get that.
due to cash flow issues, sometimes the director or the shareholder can lend money to the company.
Yeah.
And because they use the same card to access the company and the person.
Mm-hmm.
So when they withdraw the money, which they have already given to the company, sometimes they take a little bit more.
Right.
It's an error. Is there any threshold where ATO will look at, okay, it's an accident, but it's a percentage of turnover or from income, sorry, turnover or net asset,
Sure.
where ATO will be a little bit lenient. In super fund we have 5%.
Right. Good.
So is there any similar setup?
I don't believe so. Not specific like that. Yeah, it's a good question, and I think I don't believe the ATO have released any sort of safe harbors or rules of thumb like that. So it would be, I guess they would really keep their options open. But certainly in a situation like that, you would show. That's where you might say, well, that was inadvertent. That was an honest mistake, or and they may even. I guess it's a question of whether you. This is where that with 109R and those thing where the provision where you can repay and draw out again. It's that provision is intended. It's legislated to apply very broadly, and it can apply in a way where if you because one of the loopholes that was before that section was amended, there was a loophole where effectively you could take the money instead of redrawing the money, repaying the loan and taking it back out again. Would say, oh, but what if I take the money out first and then what if I put more money in and then take that out? Is that sort of then I'm just redrawing what I put in, and so but if the substance of that was it's just a bit of a sham, you're just doing it to manipulate things, and that they can still get you, but and also the amount doesn't have to be the same. It can be a large. You've got to look at the specific section, wording of that section, but so it can apply very broadly. But on the other hand, in the situation you outlined there, it clearly, the way you explained it, it really was a mistake, and it was the client, as you said, that it's effectively the shareholder was actually putting money in to help the company keep the company going. So I think if you can show that and show that okay, they took a little bit extra out, and then you put it back and you fixed it up when you realised the mistake, then you've got I think you're in a pretty good situation there. Particularly if it's not something that's happened regularly, it's just a bit of a one-off. But certainly you want to show, you want to. So there's no, I guess, just simple answer to your question is there are no rules of thumb like that. But it sounds like the sort of scenario that, particularly if it's a relatively small amount, you should be hopefully able to convince the ATO. I've certainly had ATO reviews, like next 5,000 reviews, where we've wanted to show that there were the ATO is saying, oh, there's some big balances here, and that involved in one case UPEs, so that gets an added complication. We've got UPEs and corporate beneficiaries, but then becomes a Division 7A loan. Then when I guess then almost like almost a bit of a FIFO approach. You're saying, well, if there's lots of small transactions during the year as opposed to a couple of big ones, and then you can sort of show that, well, they were we did repay the previous years. I mean, you think about clients, you've probably got clients who have multiple Div 7A loans, and so they repay the previous year's loan, but then they've taken lots of other drawings during the year. So effectively they deal with 1 year's Div 7A loan and they create another one. It's just a recurring cycle. So that can still happen because you can show that it isn't. They're not actually trying to manipulate the rules. They're just regularly taking money out, and as long as they deal with it properly. So, and that's just probably a different to your scenario, but it's along the same lines about, they're just, they're not really trying to manipulate things. It's just, as you say in your example, it was just a simple error. So I think you should be in reasonably good shape there. But if you identify that problem, again, get on the front foot. And the difficulty is, if you've got an ATO review, you can show them, okay, well, you can point it out to them, but if you don't, what do? Do you stick up your hand and apply for discretion? Depends on how much you're talking about, but perhaps you consider doing that. So, sorry, just wait for the.
Oh, I'm sorry. If you've repaid the loan before the lodgement date, for the prior year's balance, so it's no longer to Division 7, even though it was a Division 7 in the year before that.
Yep.
that's it.
Once you've repaid it, that's fine. Yeah, as long as you don't. Again, I emphasise that
You don't do it again.
As long as you don't do it, like that 109R thing. As long as you don't get into that situation, then yes, once you've repaid it, that's sort of done. And then if they do draw other amounts in the future, and there isn't really a link between the new drawings and the repayment of the old loan, then you should be fine.
And no interest is required in that year.
No. As long as if you certainly if you repay it in full. I mean, there was a question before about if you don't repay it in full, and that is a bit more complex. But if you do repay it in full, definitely you're okay. Yeah.
I've got one in online. Yeah. Yeah. Can a company deregister with ASIC if there are some loan from a director?
From a director.
Yeah. Yeah, can a company be deregistered with ASIC if there are some loan from a director? So they've still got a loan balance in the company. I suppose that's the question. There's still a director's loan balance
From it,
in
is
the
it a
company.
credit loan? Is that a credit rather than a debit? So they're saying. So if it's a liability, then yeah. I mean, I think as Henry would know, you can, as long as your assets are less than $1,000, you can deregister your company, can't you?
No, you can't just do like
I mean, you'd have to deal with. Yeah, that's right. Yeah, so you'd have to do the requirement. You have to follow the requirements for. So you'd have to clean up the balance. I guess sorry. The simple answer is Henry, isn't it? You'd have to clean up the balance sheet, wouldn't you? Yeah. So, but if you're talking about a credit loan, it's not a Division 7A problem. It's something that has to be dealt with one way or the other.
It's a director line owned by the government.
Yeah, well, that then you have to deal with. Yeah, then you have to deal with it. And certainly, I mentioned before about distributable surplus. I guess you've got to meet all the requirements of Division 7A, including having a distributable surplus that's sufficient. So, that's right. So if it's solvent, then you would probably you do some sort of a voluntary liquidation process. But one way or the other, it would need to be repaid as part of that process. We would think. So it's just, but certainly as Henry said, it comes back to meeting the requirements for a deregistration.
We normally would have to distribute those direct loans.
Yeah.
Tax have to have banking level of this tax consequences.
Yeah, correct. Yeah.
On the other side, if you buy off the line in these.
Yeah, that's right. It's really definitely not that simple, is it?
It's another one.
Okay, there's another one. If there's no distributable surplus in a year, then there is no Division 7A loan for that year. I suppose this loan is non-Division 7A loan, but what if there's distributable surplus next year? Does this loan still remain non-Division 7A or become a Division 7A loan?
I don't believe it will become a Division 7A loan. But once you've got past the year, then it's if whatever, you have to think about how that would actually happen. But if for some reason there was no distributable surplus, and then there is a distributable surplus, it wouldn't just come into Division 7A. It's the time of the loan was made. But then you've got to consider what would happen if that debt was forgiven. That's the sleeping issue in a probably scenario like that. Anytime you've got a loan that, I think it's fair to say that anytime you've got a loan that could potentially have been subject to Division 7A but wasn't, you've got to consider, well, if be very careful. Ideally, find a way not to forgive that loan, because if you forgive the loan, you potentially then have a Division 7A issue in the future. But otherwise, no. Until that point, there shouldn't be a Division 7A issue if there wasn't a distributable surplus at the time the loan was made, or in the year the loan was made, to be precise.
So if a person takes the money out in July and return the money before 30th of June, and does it again at the beginning of the next year, have Division 7A implication?
Well, it's not so much if it becomes a recurring theme, I think probably because it's if you do it once, it's something I think the Bay sort of the way Bay mentioned when he was talking before. If you do it once and you simply put money in and take it out, or take if it's dealt with within the year, then that's okay. But yeah, once that cycle repeats, then you are getting into the territory of Section 109R. So I think you have to look at the specific facts carefully, but there's a good chance that would be a Section 109R issue, and just remembering that what Section 109R actually does is to disregard a repayment, so that effectively then if the repayment's disregarded, then the actual loan becomes then a Div 7A loan, and you would think perhaps it shouldn't be. So that can be that can be quite complex, and it's been reworded. The current version of Section 109R is worded very broadly, deliberately, so as to apply to a lot of situations.
So please join me in thanking Peter for his expertise, for his insight, and in his time to come and present in our discussion group. So thanks, Peter, for your time and contribution. Your valuable contribution, I always appreciate it. Thanks everyone for coming tonight. Thanks to all of 1,000 people that turn up to our venue today. We hope to see you all back again next month. All right, next month we have our FBT update. So our email will be sent out very, very soon. So thank you once again, and have a great night.
Thanks, everyone. Well, thanks for your attention.